Hello, everyone. Thank you for joining us. In just 30 seconds or so, we'll get started. We're just going to wait for all the attendees to show up. Thank you guys for joining us today. All right, looks like we have people joining up, and we'll get started here in just a moment. Okay, thank you guys very much. My name is Nic Cary. I'm the co-founder of blockchain.com. I'm also the author of The Future is Decentralized and the founding commissioner of the Blockchain Commission for Sustainable Development. We'll be joined in just a few moments by my colleague Garrick Hileman, who I will introduce momentarily. We're here today to give you a markets update from the previous 30 days and what a month it has been. So without further ado, we'll get started. We have participants joining us from all over the world today, and we thank you very much for your time during these challenging and interesting times themselves. So we're going to be doing these market recaps on a much more regular cadence. We've had a lot of demand for this, and so we're very happy to share some of the insights that we're developing and seeing. We'll be posting follow-ups on these developments on our blog, so you can always visit blockchain.com and sign up and subscribe to that. And so even if you can't stay for the whole thing today, there's always going to be a written recap as well as a visual one. We're recording this so we can share it with everyone after the meetup. So let's go ahead and continue and talk a little bit about what we went through last time, just 2 weeks ago. So 2 weeks ago, we kind of really wanted to concentrate on three things: what blockchain.com was doing to respond to the worldwide economic crisis and also the healthcare pandemic. Talk to you a little bit about how we're addressing that from a security perspective and the resiliency of our infrastructure. I'm very happy to report that we've had very, very strong uptimes across all of the core capabilities of the platform and have actually seen record volumes and record traffic. There's a lot of interest in the work we're doing, in many ways because everything we've been concentrating on here for 7 years at blockchain.com is really coming to fruition in this moment. We were built for these times, and that's all coming sharply into focus. We also spent some time contextualizing crypto in this era, especially with the specter of COVID-19 and the policy implications and how governments are responding, and also how the workforce is changing. You know, all of us are probably working from home today, and it's quite a different way for us to interact with our community and also with each other on the blockchain.com team. It's also given us a huge opportunity to get more direct with our community and interact with you guys in more exciting ways, I think, and also using these conferences and video conferences to discuss things in real time. So for those of you that have questions, you can use the webinar today to submit those. Garrick and I will weave those in to the end of the conversation during our Q&A session. And we'll welcome anyone to ask anything you have. We'll be here to address those things. And I'll have one more slide here and summary of all the things we discussed 2 weeks ago. So 2 weeks ago, in response to the kind of wild fluctuations in both the cryptocurrency and broader global markets, we wanted to land kind of 5 key points about where we are today. And I think one of the first ones was that somehow crypto had failed or had broken down. This is a narrative that we have been combating in the industry for almost 10 years now. There's actually a famous website called Bitcoin has failed or crashed, and it's got hundreds of examples of these salacious headlines that have always been inaccurate, and so this will just be adding more of those to there. But there obviously was a lot of volatility in all of the markets, you know, some of that driven by fundamentals, some of that driven by fear. And we're going to look back in the history a little bit today and explore some examples from the past that can maybe give us some context for what we're experiencing now. The second point we wanted to land is that for those of you that have been in crypto for a while, you'll know that volatility is relatively expected and not necessarily something that is bad. And so that's a key point. We've always seen some pretty significant volatility in crypto. And in fact, 2 weeks ago was not even one of the worst periods of time in crypto. So a lot of the infrastructure has improved. You have more on-ramps using some of the top-tier banking systems with markets that are much more liquid with a lot more actors in those. And so the market can handle a lot of volatility and a lot of volume today, unlike maybe 6 or 7 years ago when it was much more frail. So there's a proclaiming of Bitcoin being digital gold that somehow that wasn't true, or the thesis was premature. This is an interesting one, and a viewpoint that's shared by myself and some other people is that, over the years since cryptocurrency was introduced as an alternative asset class and as an alternative infrastructure for finance for the internet, there were a lot of different reasons why people might have gotten interested in the crypto. And one of them was that, crypto sort of mimicked a lot of the properties of rare earth minerals. It has a fixed and limited supply, it's durable, it's difficult to destroy, and there's less and less of it coming into circulation every year. And so it has a lot of the same properties as gold, and for some people it's been called digital gold. There are cohorts of people that have gotten interested in crypto at different times. There were some of the early cryptographers and computer scientists. There was a wave of adoption in 2011, in 2013, in 2015. And then in 2017, there was this huge sort of drive into different token projects and different blockchain protocols, and a lot of fundraising happened. And each one of these cohorts kind of comes to crypto for different reasons with a different thesis. I think the digital gold one is still incredibly strong, and one that, especially in the current policy environment and with a lot of uncertainty around some of the viability of banks, will be quite interesting to see whether sovereign digital currency may in fact prove out its use case more than ever over the coming weeks and months. So I wouldn't call that one dead at all. And then the fourth key point we're trying to land, where crypto attributes are proving more valuable over the medium to long term. I think that's partially the digital gold thesis, but more broadly, being able to securely send valuable information anywhere in the world instantly and quickly. With more of us working from home and a potentially pending recession or depression being signaled by many economists in the world, the internet is kind of potentially the last great hope for the next growth engine. And the internet needs a native financial infrastructure. And so a lot of the things that people in the crypto industry have been building for the last decade are really tooling for this world. Finally, some concerns about the virus, obviously, and the use of blockchain tech. Just in the last 2 weeks, I think I've seen well over a dozen proposals to use blockchain technology to certify the movement of medical equipment across supply chains. There's an incredible amount of fraud right now occurring in the delivery of personal protective equipment to frontline medical staff. And there are already some technology solutions in place using public ledger technologies to certify and verify the authenticity of medical equipment, personal protective equipment, drugs, insulin, things like that. And I'm quite interested in the kind of moment that we have now to use some of these tools for the greater good. So it's now that I'll pass things along to our resident expert here. Please let me introduce Dr. Garrick Hileman. He's the head of research at blockchain.com and one of the world's most cited cryptocurrency and blockchain technology researchers. He created and taught the first class on blockchain technology at the University of Cambridge and has authored leading research on cryptocurrencies, markets, stable coins, which we'll spend a good deal of time talking about today, and broader economic trends. He was ranked as one of the 100 most influential economists in the United Kingdom and Ireland, and is regularly asked to share his research and perspective with government organizations and the FT, the BBC, CNBC, the Wall Street Journal, NPR, and many more. So Garrick, it's been a crazy month. We look to you for some insight today, and especially maybe a little bit with the lens of history. What are some things we can look back on and study and get a little bit of maybe waypoints for how things are going to maybe shape out over the next few weeks and coming months. So welcome Garrick to the podcast.
Great. Yeah, thanks. It's great to be back with everyone. Thanks for taking time to hear our thoughts. Just want to emphasize how much we are looking forward to the discussion with you and having more regular interaction to talk about these uncertain times together. And we know we have a really smart community here at blockchain.com. I'm looking forward to hearing the questions that you have, the thoughts you have. So let's keep this interactive as we prepare materials. We'll move into the interactive section. I look forward to hearing your comments. So today, four things: price. We want to spend a little bit of time talking about gold in particular, what happened 2008, 2011, what that may say about Bitcoin's trajectory in the months and years to come. Second, we want to talk a little about the refresh that we're doing to our charts and look specifically at hash rate and the upcoming halvening and talk about some of the mining dynamics that might play out over the next few months and what that may mean for Bitcoin's price in the short run as well as the medium term. In the third part of the agenda, we'll talk some history, both some recent history, 2008 financial crisis, as well as some older history. People are desperately looking for kind of an analogy. What's my playbook? How do I play the COVID-19 situation? And as historians like to say, history doesn't always repeat, but it often rhymes. And so maybe there's some things we can draw from history that can help us think about the current situation. And before we get to discussion, we'll have a kind of winners and losers. It's very early days and still in the COVID-19 kind of world we're in, but already we're starting to see some likely winners and some likely losers developing. And I think that's important to discuss in the context of crypto and again, what may happen in the months and years to come. So let's dive into price. So Bitcoin and gold, often compared with each other. What happened to gold exactly 12 years ago in the 2008 financial crisis? In October 2008, shortly after Lehman Brothers went belly up, gold plummeted 70% in lockstep, basically, with equities. So we saw this supposed safe haven and store of value declining during this liquidity crunch and flight to cash. Very much basically what we saw last month with gold again and equities and Bitcoin as well. Basically everything except the US dollar, in essence, selling off. So in some ways it feels like we've kind of seen this story before. And if you fast forward a little bit to 2009, as the size of the monetary response started to respond quite positively from a price perspective, up 24% in 2009, and went on to go up over 2x from its 2008 low by 2011. And so what does this tell us from a crypto perspective? Well, we think that hard assets could actually pretty quickly respond nicely to the massive stimulus and wave of monetary response that we are seeing already in response to COVID-19. And new all-time highs can be made within a few years, like we saw with gold. So, again, gold is not a perfect analogy in our view. We wrote a detailed blog post a few months ago discussing kind of the strengths and weaknesses of gold vis-a-vis Bitcoin. We view them as complementary, but we think it is a useful story to kind of keep in mind as we think about how BTC's price may respond in the months and years to come. And sure enough, Bitcoin's price and what happened last kind of following. So Bitcoin, since the crash on the March 12th through 13th, the biggest crash since December 2013, over 6 years ago, is reclaimed about 50%, since that time. Gold up 3% here in the second half of March, and then equities have continued to struggle, down over 20% for Q1, whereas Bitcoin only down around 12%. So Bitcoin's holding up in our view actually pretty well, all things considered, certainly compared to equities, and still looks very good. If you zoom out to a 12-month time frame where it's up still over 50% over the last 12 months. If you look back at the big price climbs and crashes, and this slide's got a lot of information, so don't try to read every column and row entry. I just want to focus your attention on the red box over on the right, which shows the number of days between when after correction all-time high. And the longest time was close to 1,200 days from the low in 2015 to the new all-time high in 2017. We're close to 900 days between the last all-time high in December 2017 and where we are today. In other words, we're coming up on that 1,200-day marker, and we think that's potentially very interesting. Bitcoin has always kind of grown in these kind of cycles. It's boomed, it's crashed, it's boomed. It takes some time to recover. That 2015, 2017 was the longest recovery period to make a new to all-time high. It's possible that we'll need even more time to recover, given how extraordinary 2017 was, and certainly COVID-19 adds a new twist to the story as well. But again, this history is, I think, useful for having at least some sense of kind of what's happened previously and how much time has passed before we've seen new all-time highs with Bitcoin's price. So let's turn now briefly to some of the on-chain data that we publish on blockchain.com and the hash rate. So with the price of Bitcoin plummeting, we saw the hash rate, which is the computing power that's applied to the network to secure it, to mine and try to solve these cryptographic puzzles to earn newly minted Bitcoins. We saw that plunge about by 20%, bounce back a little bit since then as the price has bounced back. And the difficulty of solving these cryptographic puzzles has also dropped and been adjusted dynamically per the rules of the protocol. Now, I don't want to go too deep into the weeds on hash rate and difficulty, but I think this is a nice time to talk a little bit about the upcoming halvening or halving of the mining reward that's scheduled for May of this year, where the reward for mining a new block will be cut from the current 12.5 Bitcoins, newly minted Bitcoins, down to 6.25 Bitcoins. And, there's a huge debate, in the industry about, is this already priced in, efficient markets hypothesis, and so on and so forth, where others might say, well, a lot of people, over 80% of people in countries like the US, Canada, Australia, know about Bitcoin, but a smaller number of people actually know or understand the halving process. And the media gets quite interested in the halving, so that's going to boost the amount of media mentions and probably Google traffic, which tends to have a positive knock-on effect for price. So is this really fully baked in? That's debatable. The point I wanted to make was that, we're in a period right now where with this price decline and the halving, the economics of mining Bitcoin are changing, and the less efficient miners are going to be stretched. And when you think about new supply of Bitcoin coming to market and putting downward pressure on the price of Bitcoin, a lot of that can come from the miners. And less efficient miners who may be locked into electricity contracts, leases, commitments to employees, and so on and so forth, they may be forced to sell some of their Bitcoin to kind of stem the bleeding from the upcoming halving and certainly the price decline. So basically, it wouldn't surprise me over the next few months if we see, some type of further volatility and additional supply coming out. But the good news is as you get to July, August, after the halving, and the weaker hands, if you will, have been kind of pruned from mining Bitcoin, then you start to have stronger hands at the table who are going to feel less selling pressure to put new Bitcoin supply to market. So I think the medium-term picture towards the latter half of this year starts to look quite positive, but buckle up potentially for some additional turbulence as inefficient miners are kind of forced maybe to cough up more of their Bitcoin stash to deal with their inefficient situation. Okay, so let's turn now to history. That doesn't always repeat, but it often rhymes. lots of talk these days of the 1918 Spanish flu. Is this a good analogy? What about the 2008 financial crisis? We talked earlier about gold and how it performed, and certainly a lot of the response that we're seeing from central banks and governments, very reminiscent. They basically have dusted off the 2008 financial crisis playbook, and we're seeing a lot of that happen. There's really, really big differences, though, I think, between the current situation, certainly the Spanish the Federal Reserve, for example, had just been invented a few years before this, was not nearly as powerful then as it is now. Public health was in its infancy. The infrastructure around drug manufacturing and epidemiology and our understanding of diseases was significantly lower than where it is today. So again, really, really hard to draw an exact parallel with what happened 100 years ago and today. We are seeing some things happening that are quite interesting, right? And like one of the things we're seeing is this kind of flight to cash we talked about, and that's also manifesting in not just a move into U.S. dollars globally, but also into physical cash being withdrawn from banks. We've seen more cash, in circulation than since the Y2K bug concern back 20 years ago. That's led to some pretty comical, frankly, and rather disconcerting videos coming from the FDIC, for example, encouraging people to keep their money in the banks and not stuff it under the mattress. We have Nick Carter, our friend at Coinmetrics here, trolling the FDIC, asking if they're nervous about something. Today, I was blown away by the New York Fed. They have a blog, and they published a blog post titled "The Value of Opacity in a Crisis." And I'm just going to, in a crisis, a policy of suppressing information on the balance sheet has a significant and positive effect on deposits. Now there's a lot of fancy words in there where basically what they're saying is if we don't tell people how bad things are inside banks, they may not panic, and that can be a good thing for not triggering a deposit crisis, a run on a bank in essence. There's been some really interesting stuff from a PR perspective coming out of institutions that I honestly has me kind of scratching my head, like who's really approving the stuff. But anyway, I guess the thing to think about, again, looking at history is, today, even before COVID-19, we had a world war level debt. The amount of government debt around the world was at a level that we had not seen since the two previous world wars, where governments spent a lot of money, of course, fighting the wars and accumulating huge debts. But we didn't fight a world war prior to COVID-19. We already accumulated this massive quantity. And on top of that, the trillions that we're going to see to deal with the unemployment crisis, with some real pressure in the commercial real estate market, which is going to have knock-on effects for banks, and so on and so forth. I mean, Ken Rogoff, who with Carmen Reinhart wrote a book on financial crises called "This Time is Different," was quoted, I think just yesterday, saying that we could be facing the, quote, mother of all financial crises. And that again, makes this period quite unprecedented. But I can tell you that after these other, periods of war, we did see, inflation. We did see things like financial repression take off, which was the subject of my doctoral research, and I wrote a number of papers on the topic of financial repression. You'll hear terms today being bandied about, like yield curve control, to basically enforce a certain price for government bonds. Yield curve control is a euphemism for financial repression, which has a whole number of trade-offs, and we think ultimately is very, very bullish for crypto, bottom line. So let's now turn to winners and losers of COVID-19, and then we'll get into discussion and some questions. So who are the winners and losers? I mean, this and there's a lot of debate about who belongs, obviously, e-commerce and the internet. Companies like Amazon are heavily in demand right now. Zoom is getting a lot of use, of course. Individuals who can create structure for themselves. People who are very capable of working remotely certainly are holding up relatively well during the lockdown. On the losing side of things, we certainly think that privacy and civil liberties potentially stand to take a big hit in this period. Surveillance has played, in many people's minds, a very constructive role in helping to address the COVID-19 pandemic. But the trade-off is you lose some privacy, and sometimes these civil liberties are hard to gain back. Central banks like the Federal Reserve, they're doing a lot of work, but savers could be big time losers in this era, and transparency certainly could be a big casualty. I mean, if you have the New York Fed coming out and arguing that we shouldn't release information about the state of banks and their health of their balance sheets, certainly we're losing something from a transparency perspective, which is a big part of what makes blockchain technology so interesting, is transparency, of course. Turning to crypto, stablecoins have been one of the early big winners without question. So if you look at the growth in the market value of stablecoins, we've almost doubled in terms of market value of the whole stablecoin category. Massive growth in particular for Tether and USDC, but also significant growth for Pax, which is supported on our platform, and some of the other stablecoins. An interesting thing about stablecoins is they offer people who don't have ready access to physical US dollars around the world, or bank deposits, the ability to actually take out a US dollar bank deposit. I can do that here in the UK, but a lot of countries don't allow that, or it's not very easy. Stablecoins offer anyone really around the world with an internet connection the ability to dollarize and to move into a relatively stable value like the US dollar. And so they're going to continue to be one of the big winners as the COVID-19 crisis plays out. And we've already seen that in a major way. But again, I mean, this is a slide we had last time. We really think that the transparency, which I just talked about, the open access, the censorship resistance, all these characteristics of crypto are really being proven right now. History and crisis often accelerates history, as they say. We were already kind of like on this migration to a new financial blockchain-powered financial system. We think this event is really going to accelerate that transition, and is just really proving out a lot of the key attributes that brought a lot of us to crypto and blockchain technology. In the beginning, looking at the macro side of things, certainly Bitcoin and BTC looks especially strong in this environment. A number of firms, Dan Morehead, Pantera, they are arguing for a reallocation away from, say, other crypto assets into Bitcoin, because it's particularly well positioned to strengthen in this environment, as kind of a macro hedge, as a real finite supply, scarce hard asset, as a project that's further developed, more mature, and requires less additional funding and work to get it to full state. That's one perspective. But overall, we think crypto really stands to benefit in this. So that's our content. Very much looking forward to your questions and discussion. Thank you very much.
Thank you, Garrick. It's certainly brought a lot of questions to mind for me. And there's one I've been meaning to ask you, and I'm glad that someone else is curious about this as well. We were anticipating a large stimulus and fiscal package to pass through Congress the last 2 weeks, and we now have the CARES stimulus bill. Can you talk a little bit about how that thing compares in size and scope to what was passed in 2008? the last financial crisis?
Yes. So, we, back then, 12 long years ago, 100 shock and awe figures that were wheeled out. That's so yesterday now. I mean, we're talking trillions, 4, 6 in the US, monetary fiscal combined, a second fiscal, package underway. I mean, it's hard to know how big this could get. I mean, if we really are facing the quote unquote mother of all financial crises, we could be looking at, a truly unprecedented amount of government response. And this is facilitated, by the way, by very low interest rates today. We aren't right now facing any concerns about inflation. If anything, we're facing the opposite: concerns about deflation or disinflation and a real demand shock. But I think the thing to keep in mind is this has had a huge supply shock as well. And so as the supply of real goods goes down and the amount of money increases chasing that reduced quantity of goods, it would not surprise me to see inflation over the coming years. Charles Goodhart here at the LSE, wrote a piece last week. He thinks double-digit inflation is certainly possible. A lot of people thought we were going to see inflation after 2008. My PhD supervisor, Neil Ferguson, and others signed a letter famously warning about inflation. That never happened. So I want to be cautious on this point. I mean, the demand shock is very, very real, and inflation is not a guarantee. But by golly, we are really setting up for, I think, a very possible inflation shock. And we haven't seen inflation in the U.S. in advanced countries in decades. Really, it's been more of an issue in developing countries. And that may be, potentially what happens again this time. Maybe the debt problems, which are particularly acute in the emerging economies, inflationary pressures, that's where we really see the real financial instability, the monetary problems, not as much in the core advanced economies. That's certainly what I would bet on. Countries that don't have a lot of reserves, countries like Indonesia, Turkey, South Africa, looking particularly vulnerable. They don't have a lot of monetary reserves. They don't have direct swap lines with the New York Fed to access US dollars directly. Those are countries maybe where there might be more pressure. But we'll see.
One of the questions I have heard a few people contemplating is, in this environment where there's basically zero interest rates or negative interest rates, how does the business model for stable coins really function?
Yeah, great question. And this has come up. It's one of the things I've been getting questions about from the media. The Block and CoinDesk and others have written some stuff on this. So it's very early days for US dollar-backed stablecoins, I think, to be in a panic about negative interest rates. We haven't seen banks trying to pass on to US dollar deposits any kind of fee or charge for depositing large sums. But if rates were to continue to push into negative territory, it really could change the current working models for many stablecoins. You might see more moving to a model like Tether, where there's some kind of fee that's charged with kind of issuing and redeeming out of the crypto token into fiat and vice versa. You could see the portfolio of backing assets behind these stablecoins start to shift into, for example, longer duration bonds, which offer still some kind of positive yield, that brings maturity risk and other risks associated with it. So I don't know that we're going to see in the U.S. With U.S. dollar deposits significant negative rates. The Fed has really resisted this. They don't think negative rates work. The evidence has not been strong from Japan and Europe that this has been a positive thing, and if anything, it leads to maybe more financial uncertainty and instability. So I think the Fed's going to fight it. but it's something that I think stablecoin issuers do need to start thinking about. And you could wind up with a kind of Libra type kind of model for many of these stablecoins where there isn't a kind of one-to-one kind of guarantee of what you're going to get back. You're going to have more of a price stabilized coin than a stable coin, because they'll be investing in things like longer duration bonds, other types of bonds, maybe to generate a positive yield to counteract the negative interest rates. And that creates kind of a risk that the value of the assets, the NAV, is fluctuating, and depending upon when you cash in and out, you may get less or more of fiat back than when you came in. So I don't think this by any means, kind of destroys the stablecoin space. It may just alter it in ways from where it is today.
It'll be interesting to see the dynamic of crypto that are non-stable coins, so things like Bitcoin and Ethereum, react to that, as some of the same pressures that fiat currencies will fall under may actually impact the stablecoin market as well. There's a question from one of the viewers today. What do you think about DeFi? Can it prove itself, and what would it mean for Ethereum's value? And I think maybe just speak a little bit to some of that, if you might.
Yeah. So I think, DeFi, is I think a really, really exciting area of crypto.
And maybe just to define DeFi in case someone doesn't know what it is.
Thank you. Always important. We throw around acronyms and it doesn't help the many stakeholders in crypto who are new to the space. DeFi stands for decentralized finance. This is often also referred to as open finance. It's the idea of basically trying to build on blockchain networks like the Ethereum network, lending protocols, ways for people to borrow, kind of trust minimized insurance systems. Lots of really interesting innovation that was really growing quite quickly last year, and very, very interesting and exciting. It went through its own stress test this past month. The MakerDAO kind of system was severely challenged, when prices collapsed on March 12th through 13th. It's a long, long story in terms of what happened. And, bottom line is there's a lot of work still to be done on making DeFi more robust. I'm actually really pleasantly, I'm very pleased with how the crypto lending space has held up in the wake of the March 12th, 13th price drop. I think a number of observers thought the whole lending space was going to be wiped out by that. That's not proven to be the case, actually, from our understanding. You always got to wait a little while to see, are there other shoes to drop, right? But so far, the reports have been very positive that the risk management used by a lot of the big crypto lending platforms held up really, really well. And, there were some liquidations, there were some margin calls, no question, but there wasn't the systemic collapse of the DeFi space or the crypto lending space as a whole. And that's really, really positive because this offers, I think, a really killer use case for crypto that, is quite compelling, especially as you start to look into the future and think about where this all could go. And if you don't mind, I just love to spend 30 to 60 seconds on this. So, we're starting to see, people earning interest in excess of what they can earn in their banks, well in excess. And even if that number comes down from the double digit 10% you could earn previously to 5%, 4%, that's still very, very attractive compared to 0% or certainly negative percent. And, there's actually millions of people out there who really, really chase deals, the points guy type community, accumulating airline miles points, best credit card deals they can find. That's a big category of users that I think is going to start to look at DeFi, and especially if you can link some of these lending and borrowing markets pretty seamlessly with, say, a debit card, you could start to see people using crypto for payments in a way that we've been kind of waiting for a number of years. This has been largely kind of a store of value, an investment asset. I think DeFi could really potentially pave the way to more use of crypto as a currency. If you can set up a way to link, debit cards that can be integrated into, say, Apple, Pay wallets and Google Pay wallets, and ideally, your salary is seamlessly converted, say, into a crypto stablecoin that's then, lent out and earning a good interest rate, and it is done so in a secure, safe way, and then it is integrated into a everyday payment system. That starts to sound pretty compelling to me, and I think a lot of users who can't be bothered with trying to learn about all the ins and outs of things like the halvening and crypto just want a better interest rate that into their iPhone. So I'm very excited about it and optimistic, and I'm very pleased the space held up really well with the recent stress test. Overall, there were some big issues, let's be clear, but overall I was pretty happy.
Yeah, it seems obvious that the decentralized finance space is it's kind of at the bleeding edge of the work that's happening in the whole cryptocurrency and digital assets industry. So I think it's wise to say that it can be a little more fragile, but based on a lot of the publicly available data, the last 2-3 months have seen a significant surge in trading volume and participants in these decentralized markets. There's a question that came in that sort of relates to this tangentially, which is there are high inflationary countries like Venezuela and Argentina where it's hard to get hold of US dollars because governments limit the availability and there are strong capital controls. In fact, you can't even buy an Apple laptop without paying an extra tax in Argentina, for example. So, one of the questions is, how do people actually get access to stable coins, and why would they choose a speculative asset like Bitcoin over one? I think the answer to that is that some of these decentralized marketplaces can actually get into these markets in a much more communal way. And whether there's actually like a physical transfer of cash in sort of a local Bitcoin type model, or local payment gateways integrating into these decentralized financial applications. So a lot of promise for that type of market to form. So some interesting things happening there, and we're already seeing entrepreneurs tackle these problems. With the enormity of the challenges that are faced in the world today, it's important to remember that there's an equal amount of opportunity to solve some of those challenges. If people are losing money by saving it, then we can create new financial instruments that actually help them earn income in new and specialized ways. And it's kind of obvious to me that with the internet sort of becoming the vehicle for which now we all have to use more to collaborate and to build businesses and communicate, that having native financial digital infrastructure for that is going to become more and more important than ever. So I think we'll maybe just have one more question here. I've got two that are sort of relevant to blockchain.com that I'll answer that have been posed. One was, could you tell us a little bit more about Blockstack and your recent airdrop program? So for those of you that don't know, one of the things that's really quite special about the cryptocurrency community and industry is that we can facilitate these things called airdrops. So when new cryptocurrency protocols basically form, they can allocate portions of their newly minted tokens or cryptocurrency assets to be given away to the public. And so we've partnered with a variety of different protocol projects to facilitate these. Famously, last year, we partnered with the Stellar Foundation and gave away over $150 million worth of Stellar. Stellar wanted more people all over the world to have access to Lumens, and we have the largest wallet in the world. So we onboarded millions of people from every country in the world that wanted to test out and use cryptocurrency. And Blockstack's no different. We're pretty interested in Blockstack for a bunch of reasons. Blockstack is working on a lot of these decentralized applications. They like to call them Web3 applications, which is a bit of a, definitely some jargon, but they're very concentrated around privacy and security and how to use the Stacks token to basically access and benefit from these applications they're building. So we've conducted the airdrop. It's already complete. We will have more airdrops in the future, and you should definitely sign up to get those. It's a free benefit of being a blockchain.com user, and we look forward to having more offerings in the future. There's also a question here about the price of the Ethereum to Great British Pound pair in the blockchain.com exchange. This question came from someone that was on the call today. I use that pretty regularly. We are currently working on building sort of an advanced internal liquidity solution to deepen that there. I'd love to actually get your input on how we can make that better. So for the person to ask that question, if you're still on the call, please feel free to either hit me up on Twitter at Nic Cary or drop me an email at nicholas@blockchain.com. Better understand what you're experiencing. We want to make sure you're having a great experience on the blockchain.com exchange. So with that, I think I'll let Garrick maybe summarize the things he wants everyone to sort of think about at the end of this overview, and we'll let you guys carry on with your week, and we hope everyone is staying healthy and safe. Garrick, what are the key takeaways you want everyone to sort of have top of mind as we finish up today?
Yeah, I mean, life is not a dress rehearsal, right? I mean, we're going through an unprecedented thing, and we believe that crypto is going to shine, in the months and years to come. But I think it's really important that you just kind of obviously, make sure you don't get overextended. There's a lot of uncertainty out there, a lot of government support coming, which is going to help hopefully a lot of people who really need help. But people are going to slip through the cracks. Just be careful. And be mindful of the fact that things can be quite bumpy and volatile during these periods of uncertainty. And one of the things that I would hate to see is people overextend themselves too much in any way. Just be cautious and mindful of the fact that this is a scary time, and we're going to get through this. We think crypto is going to come out of this on the other side, in a very strong position. But make sure you're able to hang on through the turbulence in the months and potentially years to come. This could be another depression. That's a very real possibility. Very few people alive, if anyone, really remember what that's like. So be careful out there. We're always here for you to answer any questions. We look forward to having more of these calls and in the weeks to come. And if you want to get in touch with Nick or myself on Twitter or by email, please reach out. Always happy to chat with our user base. Thank you.
Thank you, everyone. Cheers.